In this presentation, we will discuss an auditor's assessment of internal controls. As we do this, recall that the internal controls are something that we're typically going to be looking at, we're going to be assessing before we jump into the substantive type test, before we start taking a look and say, just give me the trial balance, let me start testing each type of account, let me go straight through the balance sheet accounts, the income statement accounts. We want to first test and assess internal controls to help us decide and hopefully limit the types of substantive testing that we will then do. So that's kind of where we are in the audit. We have planning, and then we have the assessment of the internal controls, typically that then being done before the substantive testing. Auditors should understand and assess effectiveness of internal controls in order to identify types of potential misstatements and factors that affect the risk of material misstatement. So as we look through the internal controls, we're going to identify those areas where the internal controls are weak, or possibly where there's some type of combination between an inherently risky thing as well as possibly weak internal controls. That's then where we're going to spend more of our time as we process through the audit, doing more substantive type of testing. An understanding of the effectiveness of internal controls helps the auditor to in designing appropriate audit procedures. And that, of course, is the goal. Note that this is basically, we're in planning, then testing the internal controls. And then once we test the internal controls, that will help us, in essence, to plan, in essence, for the actual substantive testing that we will do at that point in time or after that point in time. Risk of material misstatement. That, of course, is what we're looking for within the audit. We want to give an opinion that the financial statements are reported in accordance with whatever standard they're given to be reported in, possibly generally accepted accounting standards. We're looking for those material types of misstatements, which can take two forms. One, errors. Two, frauds. So when we think about the auditing process, remember, we're looking for the material misstatement. And we're not looking specifically necessarily as a whole or in general what the source is or what type of error it is. Now, we'll get into some specifics, but in general, the goal of the audit is to see that the financial statements are in accordance with whatever standard and free of any material misstatement, whether they are a result of errors or fraud. In other words, our goal isn't just to look for fraud or criminal type of activity, it's to give an opinion on the financial statements. That said, however, we want to consider the two types of things that could lead to a misstatement and consider what factors are involved within them. And if there's going to be a larger risk for something such as fraud as opposed to errors, or errors as opposed to fraud, then of course we want to take that into consideration as we design our tests. So errors are going to be unintentional misstatements of amounts or disclosures in the financial statements. And this is quite possible, obviously, when we put together a large process of the financial statements in accordance with some system, generally accepted accounting principles, using accrual standards, revenue recognition, and expense recognition, or the matching principle. It's quite possible that we have some issues, some problems, some errors that could be material, and we want to basically have our audit process set up so that we can detect those errors and make adjustments for them. Fraud is the intentional act by one or more among management, those charges with the governance, employees, or third parties involving the use of deception that results in the misstatement in the financial statements. So fraud is going to be intentional, errors unintentional. Obviously, the fraud is more concerning to us because it's going to be an intentional error. Notice that we are less concerned with fraud. We're going to catch the fraud, but we're less concerned when it's a lower level of fraud. So if it's a lower level of employees that are stealing from the company and we find that within our audit, one, it's very likely that that won't be as material or material to the financial statements because although it's theft, although it's fraud, it's lower on the scale, and therefore it may not be something that a third-party person who's depending on the financial statement would alter their decision or not. And if we were to take action on that scale, we could then go to the upper level of management, discuss that with them. They can basically fire the employees involved and everything is okay. We're more concerned, of course, with the upper level type of fraud, and that happens on the upper levels. Upper level management is committing fraud, especially fraud intentionally trying to deceive on the financial statements. That's going to be more of a concern, a problem, because they can go around certain types of internal controls, and that could also be more difficult to detect within the audit, which again is one of the main reasons when we go through the assessment process to pick up the clients, we want to make sure that we're picking up clients that have integrity, and therefore we can rely on, hopefully, and trust the internal controls and the management's implementation of them in good faith to some degree, of course. Examples of misstatements: inaccuracy in gathering or processing data to prepare financial statements. So we had a problem with the gathering of the data. Omission of amount or disclosure. So it might just omit something altogether. And when we think about these types of things, remember, your skepticism is on the company trying to look better as opposed to worse typically. So when we think about omission, we're thinking, well, maybe they omitted something like liabilities on the financial statements, didn't report something like liabilities somehow, or expenses possibly, as opposed to omitting a large asset that they could have put on the books or something like that. Disclosure that is not presented in accordance with generally accepted accounting principles. So it's quite possible that there's some type of disclosure that wasn't on the books in accordance with the standard that we're measuring these towards, oftentimes being generally accepted accounting principles. Incorrecting accounting estimate caused by overlooking or misinterpreting the facts. So we know that we have accounting estimates within accrual accounting. If there was an inaccurate type of estimate, then because facts being overlooked or misinterpretation, that's another cause. Fraud includes intentional misstatements. Now, the fraud components or areas of fraud, the two areas of fraud would be fraudulent financial reporting and misappropriation of assets. Now, the misappropriation of assets, if we're talking about something such as theft, misappropriating assets, oftentimes that you're talking about someone that's going to be lower on the chain in the organization. And again, that seems really, it is bad, it's theft, and so, but it's going to be easier for us to fix once found. Once we see the theft, if it's going to be someone lower on the chain, then possibly, again, it's probably not something that's large enough that may not even be material to the financial statements. We can report it to the upper level of management. They can fire that individual or look into it. They can reassess the internal controls, whatever needs to be done, and everything pushes forward as we would expect. If the fraud is in the financial reporting, that means there could be an intentional deceit in the financial reporting, possibly trying to deceit in terms of the audit as well, because obviously if they're reporting the financial statements, saying that they're reporting them in accordance with some standards such as generally accepted accounting principles, are intentionally not reporting them in accordance with that standard and trying to go through the audit with us as the auditing firm, representing that they are, when we're specifically giving an opinion that whether or not they are or not in accordance with this standard. That's of course more concerning to us because it's on the upper levels of management, and that type of fraudulent misstatement of the financial statements could be significant to the financial statements. And the reason that's such a big deal for publicly traded companies is because other people are dependent on those financial statements. So although theft seems kind of worse in if someone was actually stealing money or inventory or something like that, it's usually at a much smaller scale than a fraudulent misrepresentation of the financial statements happening at the upper level management, distorting the financial statement, resulting in facts that could result in people investing in types of companies in such a way that they would not otherwise do so. So again, the upper level management, usually that's the type of fraud that we're most concerned with, of course, with the auditors. Misappropriation of assets involves the theft of an entity's assets to the extent that the financial statements are misstated. So if we have misappropriation of assets, note in the audit, any type of misappropriation of assets, if we see theft or something like that, we can pursue that and inform the proper people within management about it. But of course, our goal within the audit is to look for those types of things that are going to have a material impact on the financial statements. That's the goal of the audit. So our audit isn't generally to find possibly theft of the employees. If it's for the opinion on the financial statements as a whole, the theft of the employees isn't our main goal. But of course, if the theft gets to the point that it's going to be causing a misappropriation or misrepresentation in the financial statements, then it falls within the scope of our financial statement, and our financial statement testing hopefully will be enough to pick that up. So this could involve the theft of assets, so actually stealing assets of the company in some degree. And again, if you're stealing something like staples or something like that, if the audit was to pick that up, could report that, but it's probably not large enough that it would actually have an impact on the reporting of the financial statements, considering materiality levels. Now, if there was large-scale theft of assets of some kind, then of course, at that level, we should be having our designing of the audit to basically pick that up. Paying for goods or services not actually received by the company. This is a common type of theft where basically there's payments that look legitimate, but they're paying for goods and services that aren't really there. And part of this would be something that might be able to be catched by a higher degree of internal controls. Not the proper verification within the internal controls could result in a type of theft where you would have people paying for services that aren't actually there. Embezzling cash received. So that would be another form of theft, of course, embezzling the cash received. Fraudulent financial reporting includes falsification, manipulation, or alteration of accounting records or supporting documents used to prepare financial statements. So we're actually taking the documents and we're falsifying the documents. Possibly someone or within the management is falsifying the documents, manipulating the documents in some way, altering the documents. Notice that this type of manipulation would have to be very conscious if we're actually creating, if the company is creating a falsification or a manipulation or actually taking documents and altering them. That is a very deliberate act basically to deceive. And usually it's to deceive on basically the higher level, because it would take the higher level of management to really go through normally and manipulate the documents in that kind of format. Intentional omission from or misappropriation in the financial statement of events, transaction, significant information. So if they were to actually say that they're going to omit activities that are happening, possibly say a loan or something like that or happen, or some type of liability on the books or something like that. Again, something that you would typically see in the upper level of management, because the types of things that would be omitted that would have a significant impact on the financial statements are those that aren't typically the day-to-day type of transactions, but the larger type of transactions, those that would have more direct control by the upper management. And also, of course, the upper management can then intervene as well within the internal controls to do something such as these types of activities. Intentional misapplication of accounting principles relating to amount, classification, manner of presentation, or disclosure. So they could basically alter what the generally accepted accounting principles are. Some types of misappropriations that have happened in the past, for example, estimates. Anytime when there's an estimate, they can alter, think about altering the estimate to be to manipulate the data. For example, they could take the assets of the company and not depreciate them according to what would be appropriate depreciation, and therefore result in assets that are overstated and possibly the expenses that are understated. Similar process could be done with allowance for doubtful accounts or something like that, understating the allowance for doubtful accounts, overstating then the net accounts receivable. These are types of things that could be done within the manipulation of the accounting using estimates. So anytime you see some type of estimated value of the assets, estimated value of liabilities, estimated depreciation, estimated allowance for doubtful accounts, those are areas where it's possible that management could try to manipulate the data in such a way that it's significant, that it would have an impact on decision makers of the financial statements.